You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome back. Sometimes it feels like the Web3 world moves faster than, well, pretty much anything else.
It really does. Constant motion.
Exactly. So today, we're trying to make sense of some really interesting shifts. Market signals, regulations, some cool new tech, maybe a bit of a Web3 Wednesdays vibe.
Yeah, we've got a mix. Some market sentiment, regulatory moves, new tech pieces. The goal is really to figure out what it all, means for where decentralized tech is going.
Okay, let's dive in. First up, a big headline. The S&P 500 committee. Well, they said no to including strategy, even though it seemed like they ticked the boxes. That feels like a bit of a cold shower for these crypto treasury companies, doesn't it?
It does. And the JP Morgan perspective you flagged is key here. They called it a blow to crypto treasuries.
Right.
It signals pretty clearly a reluctance in traditional finance to add companies that are basically just acting like Bitcoin funds into the main indexes.
So less about holding, more about doing.
Kind of, yeah. The insight seems to be that capital might shift away from those passive holding strategies towards businesses that are actively generating revenue in crypto think exchanges, miners, that sort of thing. Sign of maturation, maybe, demanding real operations, not just exposure.
Okay, interesting. But then, shifting gears a bit, we have a different signal from the regulatory side. Former SEC Chair Paul Atkins. He's talking about Project Crypto.
Right, and this idea of a minimum effective dose of regulation.
Yeah. What does that actually mean? How does that bring clarity? Or could it?
Well, Atkins's view, like you said, is that most crypto tokens aren't securities. So Project Crypto is about trying to modernize the rules to basically allow for raising capital directly on-chain, fundraising on the blockchain itself, and also trading, lending, staking, all under one sort of framework. His point is that entrepreneurs should be able to do this without, as he put it, endless legal uncertainty. It fits with that broader call for predictable rules, property rights, transparency, fair competition.
The markets need rules idea.
Exactly. Now, the minimum effective dose part. The idea is to avoid choking innovation with too much regulation, but still have enough guardrails.
The trick is getting that minimum right, I guess, making sure it's actually effective, not just a loophole.
That's the challenge, yeah, finding that balance.
Okay, so while the regulators are figuring things out, innovation just keeps going, doesn't it? And Coinbase just launched something called the Buy 402 Bazaar. Sounds intriguing. What's the story there?
Right, Buy 402. It's built on their open standard for crypto microtransactions. But the really cool part, the insight, is how it lets these dynamic agents, like AI agents, it lets them sort of browse before they pay.
Browse before they pay. How?
So imagine you task an AI with some complex research. Instead of you needing to prepay a big chunk of money for potential costs, the agent, using Buy 402, could dynamically pay tiny amounts for each bit of data it pulls, each API call it makes. It optimizes its own spending.
Wow. Okay, so it unlocks more complex stuff.
Exactly. Things like LLM inference, the actual processing part of AI requests, or detailed financial analysis. Before, developers often had to guess and prepay. This changes the cost dynamic. It could really unleash more autonomous applications.
And you mentioned something else quickly there, Upbit.
Oh yeah, just another sign of the pace. Upbit launched their Giwa Layer 2 on testnet, built on the OP stack, aiming for super fast, like 1-second block times. It's part of this whole flurry of L2s trying to scale things up.
Right, scaling is always the name of the game. Now, speaking of innovation, but maybe on the riskier side, Pendle had a huge milestone, $11.3 billion in total value locked.
Massive number.
And there's this new platform, Boros, letting people trade funding rates directly. That sounds sophisticated and maybe a bit dangerous.
It definitely can be. That optimistic funding rate trading strategy on Boros is essentially betting on which way those funding rates, the payments between longs and shorts, are going to move.
So you're trying to capture gains from the rate shifts themselves.
Precisely. But yeah, high risk. If you time it wrong, you can face pretty significant losses. It's not for the faint of heart.
Which actually leads nicely into another point you highlighted this piece, arguing blockchains might be fundamentally unsuitable for most applications. That sounds pretty counter to the usual hype.
It is. It's from world computer to guarantee machine. It challenges that early idea of the blockchain as this universal world computer ready for any app.
Why? What are the constraints?
Things like gas costs, relying on oracles for real-world data. These make even simple apps quite difficult and expensive sometimes. The argument is that maybe blockchains are better suited as guarantee machines.
Guarantee machines.
Yeah, for specific tasks where their core strength providing unparalleled security and trust is really needed. High assurance stuff. It's a kind of reevaluation of where blockchain truly shines, beyond just being a general purpose computer, acknowledging the practical limits.
That makes sense. Finding the right tool for the job. Okay, and quickly, in the stablecoin world, Bastion proposing to issue Hyperliquid's USDH. What makes that proposal stand out in such a crowded field?
Well, Bastion's pitch is interesting. They're positioning themselves as a totally neutral partner. They don't have their own competing chain or stablecoin.
Uh-huh.
And they really lean into their U.S. regulatory compliance, having a New York trust charter. The proposal itself details USDH as a full-stack stablecoin, importantly with segregated bankruptcy remote reserves.
Meaning the user funds are separate and protected.
Exactly, even if Bastion itself ran into trouble. And a huge chunk, 95% of the yield generated from the reserves, would go back into growing the Hyperliquid ecosystem. They want USDH to be the base stablecoin there.
So neutrality, compliance, and reinvestment.
Got it. Wow, what a ride through the landscape this week. From the S&P being cautious, regulators looking for that minimum dose, to just relentless innovation like by 402 and these layer 2s. It's such a dynamic picture. It really is.
Yeah.
And if you step back and connect the dots, it raises a big question, doesn't it? As these crypto markets try to mature and the tech itself keeps evolving so fast, how do you actually balance that fundamental need for clear rules and safety nets with this incredibly energetic, sometimes chaotic spirit of innovation?
That is definitely something to chew on. Food for thought. Until next time. Thanks for joining us for this exploration.
Spoken Tech for your ears.